Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another financial podcast from the Cambridge Financial Podcast channel. Today we're going to have a very good conversation, and this is this episode is called A Financial Conversation on Taxes and Tax Reform. And I thought it would be important for me to cover some of the issues and concerns that we're seeing today, especially with all the tax reform conversations that are taking place every time we listen to the radio or turn on the TV. And obviously you have, Democrats taking a certain position, you have the Republicans taking other positions, you have independents taking a different view altogether. But at the end of the day, I'm going to try to give you the good, the bad, and the ugly based on what we know today. There's one thing I do want to make certain that we all understand is that, we as Americans cannot allow anyone to dictate our tax bracket in retirement or in the future from that perspective. And that's very critical because at the end of the day, it is our responsibility, it is your responsibility to manage your taxes. Because taxes, like everything else that happens in this country, is changing all the time. And most of the time it's not changing for the better. So we have to make certain that regardless of where we find ourselves, either later on in the future or in retirement, that we have full control over our tax liability as we move through. Now, always remember from an economic standpoint that the government cannot give you anything that they don't take away from you to begin with. And that applies to just about every employee benefit, every social benefit that you find in this country. They have to take the money from someone in order to give it to someone else. And as I always say, is you're borrowing from Peter to pay Paul, and life is good until Peter runs out of money, and then Paul is in trouble from a business standpoint. Now, I'm going to cover with you what I consider to be a fast approaching train. And many a times, even if you happen to be on the right track, if the train is approaching and is doing 100, 200 miles an hour, if you don't get out of the way, you're going to get run over, and you're not going to end up in a way that you felt you were going to end up in the future. So what are some of the issues that I see in this fast approaching train wreck, or a fast approaching economy that I see moving forward into the future? Number one, what are some of the booby traps that I see out there? Social Security and Medicare, the unfunded liabilities for both of these programs, it's at $120 trillion and counting. That's an enormous number to look at. The U.S. national debt is currently at $20 trillion, and that's actually growing by $2.7 billion a day. So the unfunded liabilities for both Social Security and Medicare are actually increasing by approximately $4 trillion every single year. I don't think there's any tax plan that can be put together, or any type of employee benefit that can be put together, that will be able to offset those tax liabilities that we already have. And it means, when I say tax liabilities, it means that these are liabilities that we have to cover in the future, and we don't have any money to do so today. Now, one of the things that you hear all the time, and you hear this, and I'm not taking sides at this point in time, I'm just giving you facts. One of the things that we hear from the Democratic side of the House is that, obviously this is a tax break for the rich, and the rich needs to pay their fair share. Now, as an economist and a financial advisor for many, many years, one of the normal questions that I always ask is, well, what's your definition, or what's the definition of a fair share? Let me give you some of the statistics and some of the actual numbers on taxes in the United States of America today. So, for instance, the top 1% of income earners, and by the way, there are only 892,000 of them. So we have north of 330 million Americans in the U.S., and less than 1 million of them are what we consider to be the top 1%. So 892,000 top earners in this country, they pay 40% of all federal income taxes. And just so you have a definition of what a top earner is anyone who makes at least $480,000 a year. So $480,000 and above, you're considered to be in the top 1% of income earners in the U.S., yet all of you are paying 40% of all the federal income taxes. Now, on the other side of that coin, there are 44% of income earners. So that's about 77 million Americans. Remember, we only have 892,000 on the top 1%, but we have 77 million Americans that pay no federal income taxes whatsoever. So 1% is paying 40% of all the taxes, and 77 million Americans pay no taxes whatsoever. Now, the top 10% of income earners, and that's about roughly 1.7 million of us, we pay 70% of all federal income taxes. And by the way, to be in the top 10% of income earners, you have to earn at least $138,000 a year or higher. Now, the bottom 50% of income earners pay less than 3% of all federal income taxes. And the bottom 50%, the definition for that is anyone that earns $39,000 a year or less. So it's very, very critical to understand that when the Democrats and some people talk about, that the top earners in this country have to pay their fair share, obviously they're already paying 40% of all the federal income taxes in the U.S. And then you have 44% of Americans that pay no income taxes at all. And then obviously the top 10% pays, over 70% of all the taxes in this country. So there's a tremendous disparity when it comes to tax planning in this country and how the tax rules apply to each and every one of us. Now, the other major issue is that by the year 2020, 92 cents out of every dollar is going to go towards Social Security, Medicare, Medicaid, and interest on the national debt, because we do owe a tremendous amount of money. We owe, $20 trillion in debt in this country. Now, let me give you an example, because many a times, and I cover this in most of my podcasts and many of the webinars that we do, people have a very challenging decision, or they have a very challenging time in truly understanding what $1 trillion is. Remember, we have in just liabilities, Medicare and Social Security, $120 trillion in liability, and our debt is at $20 trillion and counting. So let me give you an example. If you as a business owner were born the year that Jesus was born, which was a year 0, that's why we have AD and BC, before Christ, and Anno Domini, the year of our Lord. So if you opened a business and you were the worst business owner in the world, and you lost $1 million a day since the day that Jesus was born, so that's 2017 years ago, and you lost $1 million a day over all that time since the birth of Jesus, you would have only lost $736 billion in 2017 years. You're not even at $1 trillion of losses in 2017 years. Yes, yet our debt in our country exceeds $20 trillion at this point in time. Now, what are some of the other fast approaching challenges that we see in the marketplace? Well, Social Security, it's pretty much bankrupt. And the reason is simple. In 1935, when it was put together, for every American that was employed, there were 42 Americans for every one American that was retired, there were 42 Americans that were employed. And the reason for that is this is a pay-as-you-go system. So obviously, from that perspective, Today, the ratio is 3 to 1. So for every retiree, we only have 3 Americans working. So that becomes a major, major problem because, by the year 2026, the ratio is going to go down to 2 to 1 from a Social Security perspective. So that will become a major issue that we have to deal with. Now, based on current fiscal policy and economic policy, future taxes will have to double or our country will go financially bankrupt. And that was a statement that was made about 10 years ago by David Walker, who was a CPA Comptroller General of the United States, and he was the head of the GAO, which is the Government Accountability Office. Pretty much, they're the CPAs for the U.S. For the United States of America. So he is basically saying that unless taxes are to double, there's a very high probability that we're not going to be able to make it to the promised land. Now, one of the major issues that we discuss with our clients regularly is that tax reduction carries no financial risk whatsoever. So all of these things, all of this information that I'm giving you all is basically to kind of get you to start thinking through all the issues and concerns that most of us are going to have to be facing in the future. Now, most of the clients that we deal with, the majority of their savings for retirement are in qualified plans. And the challenges with qualified plans is that their statements do not tell you how much of the money in that statement belongs to the IRS. Obviously, you get your statements. You may get the statements quarterly. You do get an annual statement once a year, and you look at your account. You have $300,000, $500,000. You may have $1 million. I have clients of mine that have over $2 million in their qualified plan statements. But what those statements don't tell these clients is how much of it belongs to the IRS. So when you first look at the statement, you feel that all that money is yours, and that is not the case. Another major issue that we have with qualified plans in the United States is that if it makes money, you pay taxes. If it doesn't make money, you pay taxes. So at the end of the day, welcome to the United States and the United States of America and the United States tax system. Now, in a lot of the planning that we do with our clients is, our number one goal is to reduce their taxes significantly in retirement. And most important, we also want to get them to the perfect tax bracket as far as I'm concerned, and that number is 0. So if I can get you as a client to the 0% tax bracket, then it really doesn't matter where taxes are going to be in the future, because you're going to be in a much better position than you were before we started working together. Now, building wealth is not about rates of returns. It's about the efficiency of money while fighting all of your eroding factors. And what are those? And the major ones. Taxes, inflation, stock market volatility, interest rate volatility, lawsuits, financial fees, propensity to spend and consume. All of these things are eroding factors that are attacking us every single day of the week. Now, whenever we do audits for new clients and existing clients based on the monies that they have and what they're earmarking for investments, we have to have a good discussion on the most tax-efficient vehicles in the IRS code. And there are pretty much 4 of them, but I'm only going to talk about 3 of them for a reason that I'll give you in a couple of seconds. You have your municipal bonds, you have your Roth IRAs, you have your Roth 401ks, and you have what we call the PERPs, which are the personal insurance retirement plans or life insurance from a tax perspective. And the reason why I'm not going to mention municipal bonds other than this is that although the interest that you generate from municipal bonds are free from federal income taxes and are not taxed at the federal level, they do have a negative impact on your provisional income calculations for Social Security. So if you get enough of municipal bond income coming in at the end of the year or throughout the year, it may have a negative impact on your Social Security calculations, and therefore, instead of paying zero for your Social Security benefits and income taxes, you may end up paying 50% or maybe even 85% of your Social Security benefits that would be taxable to you. Now, Roth IRAs, tremendous benefit. Now, in order for you to get to the 0% tax bracket, or to get to the point where you're only going to pay taxes on your money once, or you're going to get to the point where you're going to reduce your taxes significantly, you have to be able and willing to pay the taxes today. And that's something very important, because when you put money in a Roth IRA or a Roth 401k, you have already paid taxes on that money. The money's going to grow tax deferred. You're going to be able to pull it out tax-free in the future. It also has a lot of other benefits. They're creditor protected in the United States, so even if you get sued, you're going to have some protection there as well. You're not going to have to abide by the 70.5 rule, which is a required minimum distribution rule, which forces you to take money out of your qualified plans once you reach the age of 70.5, whether you want to or not. But you do have to abide by the premature distribution rules, or the 59.5 rules. So Roth IRAs are excellent vehicles. Roth 401ks are really, really good. The difference between the two is also the fact that in a Roth 401k, because it is an employer-sponsored plan, you do have the ability to put more money in a Roth 401k than you could in a Roth IRA. Last but not least is life insurance, or the personal insurance retirement plan. And this one has a tremendous amount of benefits. Again, you have a tax-free death benefit. You have the money growing in your plan tax-free, is tax-free growth. Tax-free distribution, the same for Roth IRAs and Roth IRAs and Roth 401ks. Tax-free transfers if you do it properly. This one has an additional benefit, because you have no 59.5 rule for premature distribution, so you can pull money out at any time and not have to worry about paying a tax liability through critical features that they do have. You don't have to worry about the 70.5 rule, because it's not part of the plan, so you have that tremendous benefit as well. It is creditor protection in certain states. Obviously, we live in the state of Florida here, so it's fully protected in the state of Florida. It's a self-completing plan, not only for death benefit, but also for disability, because you may be working for an employer, making great contributions to your Roth IRA, your Roth 401ks, or your qualified plans. If you become disabled and you can no longer make contributions, well, the employer is not going to make that contribution for you. If you happen to die, whatever happens to be in the plan at that point in time, that's what your family will receive. With the PERP, you have those additional features. So it's self-completing, because you can have disability riders that will continue to fund the plan at the level that you were funding it. So you have a great benefit there. And also, if you happen to die, you're going to get the tax-free death benefit that will make your family whole and pay a much, much higher benefit than whatever you had or you would have accumulated in your Roth IRA or 401k. So, and this one obviously does not create any Social Security tax triggers, so it works the same as your Roth IRA and Roth 401k. So the most tax efficient vehicles in the IRS code from a business standpoint are your Roth IRAs, your Roth 401ks, and your personal insurance retirement plans. Now, let's talk a little bit about the proposed tax plan that we're seeing now in Congress. And again, I'll give you the good, the bad, and the ugly on this plan. And let me preface this by saying that no tax plan will ever be equitable unless we go to a flat tax system. Now, some Senators have talked about flat taxes and a flat tax system for many, many years, but obviously there are a lot of people in Washington that don't like that idea, so they're not willing to move forward on that. But that would be pretty much the only way where it could be an equitable benefit for everyone. Now, the proposed tax plan obviously is being looked at from the Senate side and also from the House of Representatives side. So the Senate keeps the current 7 tax brackets that we have. So when you look at 2017 and before that, we have had 7 tax brackets. So you have the 10%, the 15%, the 25%, the 28%, the 33%, the 35%, and then last but not least is the 39.6%. With the 2018 plan, it would be reduced, at least on the House side, to 4 tax brackets. You would have the 12%, the 25 to 35%, and then the 39.6. But there may be a 5th bracket for anyone that makes at least $1 million. So those are things that are critical. Now, what's going to happen there, who knows? Because once both plans are put together, then they will go to committee, and then the committees will decide, take the best out of each plan and see if they can come up with one that could be approved by the entire Congress, or at least a Republican side, since they have the power at this point in time, and then hopefully be signed by the President of the United States. Now, the Senate plan keeps the deductions for medical expenses, and the House plan pretty much eliminates them. Now, both plans eliminate the deduction for state and local taxes, and that's what they call the SALT plan. And obviously, that's going to negatively impact high taxable states, and primarily New York and California. So it could hurt approximately 40 million people, but it would also add $1.3 trillion to additional federal revenues on an annual basis. So again, as I'm saying, there are certain benefits on one side of the ledger, and that may have a negative impact on the other side of the ledger as well. Now, the Trump plan, and this is a plan that he came out with to begin with, and that now went to the Senate and the House, and they're going to start taking it apart, doubles the standard deduction, and we do tax planning at Cambridge. So currently, if you're married filing jointly for 2017, your standard deduction is $12,700. If you're a single filer in 2017, your standard deduction is $6,350. So the plan is going to almost double the standard deduction. So if you're married filing jointly, you'll go from $12,700 to $24,000, and if you're a single filer, you would go from $6,350 to $12,000. Now, the House also eliminates personal exemptions. Right now, just by being born, you have a personal exemption of $4,050 per person. So in 2017, the way the current law reads, you have a standard deduction, husband and wife, for $12,700, and then they can claim a personal exemption for each of them, plus a personal exemption for children in the household. And that could be, if you have 2 children, that would amount to $8,100, and so forth. Now, the House plan doubles also the estate tax exemption. So right now, if you happen to be a high net worth individual, the current estate tax is at $5,490,000. And it would double to $11 million, and it's supposed to phase out in 6 years. The estate tax is nothing more than a death tax, And one of the major problems that we have had in this country is that the estate tax has come and gone approximately 18 times in the history of this country. So whenever we need to generate additional revenues, we impose a death tax. As a financial advisor, I have always taken the attitude that, death should not create a tax liability, especially on assets that have already paid taxes for many, many years. It's from a socialistic standpoint, is considered to be a redistribution of wealth, but I'm a capitalist. I don't want anyone to redistribute the wealth that I earned, that I worked very hard for myself and my family. I want to redistribute that wealth to the next generation and let them move the business or the assets forward along those lines. But that's just my personal observation on that. Now, the Tax Act eliminates the alternative minimum tax, and that's the AMT. And the challenge that we have had for many years, those of us that do tax planning for clients, is that AMT does not increase with inflation, which means as more and more Americans are making money today, more and more of them are falling into the AMT liability. And basically that means that if you happen to be a tax-paying American and you do have certain tax deductions and benefits that you get, if you get too many of those, then those are going to start being phased out and they're going to bring you back so you can pay more in taxes. The problem is that the AMT in 2017 could affect income earners, especially married filing jointly, husband and wife, that make somewhere around $84,500, which is not a lot of money to begin with, yet you may have to pay an alternative minimum tax on that. And if you happen to be a single filer, then it would be $54,000. Now, child and elder care deductions would increase, and based on what we see today, from $1,000 to $1,600. And I think both plans, both the Senate and the House, they lower the maximum corporate rate from 35% to 20%. But it may not be permanent, so it all depends on where it's going to fall when the decisions are made in the next couple of months, if possible. Now, for small businesses, the House plan lowers the tax rate to 25%. I think that's important because the growth in this country is not necessarily from the major corporations, although obviously they hire millions and millions of employees throughout the United States on an annual basis. But the major growth, comes from the mom and pops, small businesses that are here in the United States and in many parts of other places as well. So the Tax Act also allows for businesses to be able to expense the cost of assets that are depreciating in value and so forth. And if you happen to be part or own a C corporation, you would lose the ability to deduct interest expense. So those are things, and there are many other line items there that I'm not going to get into because they're quite complex and we just don't know where they're going to go at this point in time. Now, all of these things, what Trump is trying to do, what the Republicans are trying to do, again, whether you're on one side of the aisle or the other, it doesn't matter. It really depends on how you look at the different issues and concerns when it comes to economics and tax planning. But the type of work that is being done now, and I think the foundation of the tax reform that we're seeing today, at least going through the House and the Senate, is what we call in supply-side economics. Now, it may work in 2017 and beyond. I know that it did work during the Reagan years. Now, obviously, taxes were much higher then. It was at 70% at one point in time. By the way, we have had top marginal tax brackets in the U.S. as high as 90% in the history of the U.S. And since the 1930s, the average tax rate in the U.S. has been in the 60% 8% tax bracket. So it's been very, very high. Now, today we're at a fairly low, we're actually at the third lowest tax rate historically that we've ever been. Now, the first one was in 1913 when the income tax was created, the Internal Revenue Service was created, and the taxes then were very, very low. Then obviously we went through a low tax bracket during the Depression. The government was forced to reduce taxes in order for Americans to be able to meet their goals and maintain their standard of living and so forth. But right after the Depression, taxes went through the roof, to the point that if you were earning a very good income in the United States, 90 cents out of every dollar would go toward taxes. And that was one of the major issues that prompted Ronald Reagan, who was an actor at that point in time, to actually run for office, because back then he would only make 2 movies a year, because he didn't want to reach that point where, for every dollar that he made, 90 cents of those dollars would go to the federal government in the form of federal income taxes. So obviously, everyone is making a bet that if we're able to reduce taxes, not only at the individual level, but also at the corporate level, it can create more jobs. It can allow Americans to save more money and invest and maybe open businesses. It can create higher skilled employment for certain companies. Companies can then take some of those savings and pay higher salaries. And most important, be able to offer more employee benefits to employees and Americans throughout the United States. Now, I have owned my own business for many, many years, and I pay attention to taxes. I pay attention to expenses in my firm. Whenever I need to pay salaries, I'm going to take a lot of those things into consideration. Many times I need to hire less people because I don't want to have to pay any more when it comes to FICA. As a matter of fact, one of the major problems that Obamacare created is that if you were above 50 employees, you were mandated to provide health care benefits to all your employees. So many employers, many of my clients that were hovering anywhere between 45 to 50 employees, they actually started to reduce their employee, and they refused to grow. And they're still refusing to grow today because of the fact that Obamacare then adds an additional liability, tax liability and expense liability to a small business owner. And many small business owners are people like you and I that are trying to make a living, and they're trying to do that in the most cost-efficient way along those lines. Now, all of these things that we have talked about is more than likely going to take place under budget reconciliation, because in order for it to be a tax reform like what Ronald Reagan was able to do back in 1986, you need 60% approval from Congress. And I don't think that in this litigious and political environment that we're living in today, you were going to be able to find 60 votes anywhere, especially getting another 8 votes from the Democrats on the other side of the aisle. That's going to be pretty much an impossibility, although many Democrats are probably going to be put on the spot, because if these tax benefits are going to reduce the tax liability for middle income families, which are the ones that deserve and need the tax break, then I think these legislators are going to have a difficult time saying no or voting against it. But at this point in time, I'm crossing my fingers and hoping for the best from a business standpoint. But if it does happen under budget reconciliation, it's for a maximum of 10 years. So in year 11, whomever happens to be in power at that point in time, actually the taxes in year 11 will go back to where they're at today. So you may be 55 years of age today, you're going to retire in 10 years, or you may be 60 years of age today, and 10 years from now you're going to be 70, and you may find yourself in a higher tax bracket in the future than you are today. So the bottom line to this conversation that I'm having with all of you today, and I appreciate all of you being here and listening, is that no one knows what the ultimate plan is going to look like. When will it be implemented? Are they going to go retroactive to January 1 of 2016, or is this going to take effect in 2018? And again, who's coming next? You know, who's going to be in power in the next 4 years? Who's going to be in power in the next 8 years? Who's going to be in power once budget reconciliation sunsets in 10 years from now? So again, all of these issues are things that you need to pay attention to. At the end of the day, as I said at the very, very beginning of this podcast, you cannot allow anyone to dictate your tax bracket in retirement. And that's the type of work that we do at Cambridge. We specialize in doing tax planning not only for today but for tomorrow. But by doing our tax planning techniques and using our tax planning blueprint, we're able to reduce your taxes significantly every single year moving into the future. We also have tax planning webinars. We're actually having one tonight. We usually have them on Tuesdays and Thursdays, and they're called how to reduce the impact of taxes in retirement. So feel free to reach out and send me an email at bert.salazar, S-A-L-A-Z-A-R, at Cambridge, F as in Frank, P as in Paul, LLC.com, and I will be more than happy to send you an invite along those lines. And as always, I like to finish every single podcast by basically stating that the number one job that we have at Cambridge, and the number one thing that I do for each and every one of my clients every single day, is to get them to change the way that they see things. Because when people change the way they see things, the things they see change. Again, thank you so very much for giving us a little bit of your time today, and we look forward to seeing you at the next podcast next week. Have a great day.